I'm going to talk about a new paper which is not corporate finance and which has a significant empirical dimension. Okay, and the last caveat, as yesterday when Vincent made the opening remarks, he made it very clear that all papers in the conference had been selected through a very strict peer review process, except the invited talks. So I hope you will like it anyway. So it's joint. This is joint work with so Bruno, whom you have identified quite well by now, Christophe Bizière, who is also here, who is my colleague at TSE, Mathieu Bouvard from McGill, and Albert Mengveld from Amsterdam. Okay, so yeah, so what is okay? Why did we start working on the pricing of Bitcoin? So usually, if you want to to buy goods and services, you will use your national currency. You will use standard money that is created by central banks, or cash, or by commercial banks. And in general, everything goes well, but sometimes no. It can be that these institutions are not totally trustworthy. It may be that you face some inflation. You might be expropriated, or maybe the bank could collapse. I mean, think of what happens in some countries, in Venezuela or in Zimbabwe. And one, maybe not the only one, but one motive behind the invention of cryptocurrencies like Bitcoin was to provide an alternative means of payment. As Nakamoto writes it, Bitcoin allows online payments to be sent directly from one party to another without going through a financial institution. And what we want to explore is this dimension. Can it work? Can we have this, do people consider these cryptocurrencies as alternative means of payments, or is it just like, a fad or a bubble about to burst? Now, as Delaya mentioned it earlier today, maybe this audience is full of cryptocurrency enthusiasts, but believe me, in the outside world, this is not totally the case. And we've seen a lot of warnings by prominent economists. I don't have I don't have quotes from computer scientists. I should have that. Last November, the director of the Bank of International Settlements, wrote, for payments where buyer and seller never meet, trust is vital. So a decentralized network cannot replace tried and tested institutions. And now, an even more prominent, at least to me, economist, so my boss, Jean Tirole, wrote, Bitcoin is a pure bubble. Its price will fall to zero if trust vanishes. Okay, but
the day after it started falling.
Actually, the difference between Jean and Carsten is that after Jean spoke, price went down. Yeah. After Carsten spoke, prices went up.
So let me remind me to put Jean's quote in our events in the empirical part of the paper. We don't have him, actually. But still, okay, with its ups and downs, if you look at the history of Bitcoin, it was valued almost zero in 2010. And now, last week at least, I didn't check today. Each time I present this paper, I should check in the morning whether Bitcoin still exists. I'm sorry. Did you do that? Last week it was still around $5,300, but you see that, okay, with some ups and downs towards the end of the period, the Bitcoin still exists. And there are some transactions going on. So for the moment, these are only data that are publicly available on blockchain.info, but we'll use other data later. And the question is, okay, are these prices the result of some irrational behavior, or are people irrational when they do these transactions? And again, some prominent voices seem to think it is the case. Okay, Alan Greenspan, you cannot tell me that you can create out of nothing something which has a medium of exchange value. It's not a rational currency in that sense. And our ambition is to say, okay, let's frame all this in a rational setting. So let's build a rational expectation equilibrium. That's the REE model of Bitcoin. Yes.
But isn't that what the central banks do? They turn on the printing press, and there's value out of nothing.
You're right.
Magic.
You're absolutely right. That's exactly the yeah. But he seems to think that they are more trustworthy.
Okay, so it's a mockery.
That's the and what we want to do is to have the most, I would say, standard or canonical model, rational expectation equilibrium model that we can confront to the data. And I think the main contribution of this paper is really in the confrontation of this model to the data. And so to build our model, we start from really the basic question in economics: what is money? What is money? Among other stuff, it's a way to solve what we call the non-double coincidence of wants problem. So a crash course in monetary economics. What is it? Super simple. Suppose I have apples, but I want chocolate. And then I meet Jason. Jason has chocolate, and he likes apples. And then we're fine, because we're going to exchange our apples and our chocolate, and we'll be super happy. But now imagine that Jason, he wants apples, but he has coffee. I don't want coffee. I want chocolate. So I could accept his coffee, but really, I don't like it so much. And what I'm going to do, I would need to find someone else who has coffee against chocolate. It's going to be a mess. In that case, money is a way for us to make an exchange. Is a way for Jason to buy my apples. And I will accept money because I will think that later on, other people will accept it to sell me chocolate. And we will build a model that uses this insight, which is extremely standard in monetary economics. And Linda presented one model in which you had, at every period, the green and the red agents who have this non-double coincidence of wants problem. We use a slightly different setting, which is the simplest you can think of to model this idea of non-double coincidence of wants. We will use an overlapping generation model. So overlapping generation model means at each period, you have two generations of people. You have young people and old people. The young people, they have apples, and they would like to save some for when they're old. But the only people they meet are the old ones. And the old ones, they're happy to take the apples. But they will not be there next period to give them back, because they will not be there, precisely. And so this is where money will be useful. Because the young and old will be able to exchange apples with money. And the next period, the young will use the money, who have become old, will use the money to buy the apples, okay? So I should say at this stage that please feel free to interrupt at any time. In economics, we are used to that. I mean, you saw Bruno interrupting everyone all the time. And if there is something that is not clear, please raise your hand and I will be happy to answer. Okay. Was there a hand? No. I'm sure you know a bit all this. Should say it's a mix of both. I mean, you will need to, your goods are perishable, you will need to transfer them tomorrow and to, yeah, okay, you could describe it with the two interpretations. So we'll have this very standard overlapping generation model with two currencies that will be really in line with the type of model that you had with Neil Wallace. So we'll be in this line of in this family of models. We'll try to incorporate in this model some distinguishing, what we think are distinguishing features of cryptocurrencies. And those will be transactional costs and benefits, a little bit like what Linda Schilling mentioned for the transactional costs part. And that will give us an equilibrium pricing equation for Bitcoin. And that will reflect these transactional costs and benefits of cryptocurrencies. And this is what we will define as the fundamental value of a cryptocurrency. And so far, you know, apart from our specifications, which will be particular to our model, it's going to be a pretty standard model. And then we will collect data on Bitcoin and try to be as careful as we can to collect data that can be good proxies for the variables of our model. Okay, and that will be probably the most original part of the, I mean, I don't know what my co-authors think, but to me, this is probably the most original contribution of the paper. And we'll use this data to test our rational expectation equilibrium pricing relation and to try to give some estimate of what could be the fundamental value of Bitcoin attributed by people given the dynamics of prices that we have seen in the last 10 years. Okay? So that's the roadmap of the talk. Before that, I would like to mention the literature, although I should say that by now you should be aware of a lot of it. Well, because well, at least some papers, because they've been presented yesterday or today. Before describing them, just look at the dates. So for computer science, it might be usual to have only very recent dates, but for economics, this is not usual at all. And it means that there has been in the last year, or in the last year and a half, a lot of papers on this question and not many before that, in fact. So it's really a growing literature in economics. So you have some papers that try to endogenize the value of Bitcoin or cryptocurrencies or the price of Bitcoin by relying on this idea that it gives access to a network. Okay, and for instance, yesterday, William Kong presented a very nice piece built on this idea. And there are a couple of papers on that. And these are mostly theoretical, although there is some, at the end, some illustration with data. The objective is mostly to build these models. Then you have some purely empirical papers. So some of them look at, you know, what happens to what Bitcoin prices look like. So there are papers which says, okay, it's super dispersed. It's a fragmented market, and there's no one. There isn't a single price for Bitcoin at every date. Then you have some empirical studies on, you know, the dynamics of Bitcoin, whether it correlates with other macroeconomic variables, whether it changes with some news when Jean Tirole talks or when Agustin Karsten talks. The Auer and Claessens paper is about that, whether the price reacts to when prominent people talk about Bitcoin. Julien has a paper on how miners react to these changes in prices. And then there is a series of papers which is, I would say, more closely related to our work. And these papers, by and large, they try to model competition between cryptocurrencies and fiat currencies. And so Rodney, Garat, and Wallace have a paper, Bitcoin 1, 2, 3, and we'll share a lot with their framework. Linda has presented her paper, which has also a lot of common features with ours. Thorsten has presented a paper that also studies the pricing of cryptocurrencies. Okay, so we are in this line of literature. Okay, so the model. So So in the model, we have the really important agents are the investors. These are the people who live for 2 periods. So if an investor is born at day t, he lives until t+1, and he will receive some stochastic endowments when young, so apples, when young and old. And young investors have to make decisions on what to do with these endowments, with these apples. So they can consume them, or in part, or they can save them in order to consume them later, to consume later. So how can you save? Just to be more complete on the discussion we had earlier, they can buy a risk-free asset, so that delivers a fixed number of apples next period, and that is in 0 net supply. Or they have access to 2 types of currencies. So one is a central bank currency, dollar or euro, whatever. And the other one is a cryptocurrency. And you will see on the next slide the difference between the two. And then when these investors get old, what they do is only consuming. So they consume all they have. They can sell all their holdings of central bank currencies, cryptocurrencies, or risk-free assets, but in equilibrium they won't have any. And then we have 2 other types of agents who don't do much, I should say. They could do a little bit more without changing our equilibrium equation, but for simplicity for the moment they don't do much. We have the miners. So the miners in our setting, the only thing that they do is to get some transaction fees and to get as rewards the increase in the supply of Bitcoin. So at every period, the supply of Bitcoin increases. It's given as rewards. It's the coin-based transactions for miners. And once they get them, they consume them. Okay. And then we'll have other agents whom we called hackers. And the idea is that when you buy Bitcoins, maybe some of them will be stolen before you will be able to sell them again next period. And they are stolen by hackers. So hackers, they are born at day t, and then at day t+1, they receive a fraction that we don't specify. It's a random variable, but we don't say anything about it. They receive a fraction of the cryptocurrency supply that was there the period before, and then they sell also and they consume, okay? And at each date, you have a supply of the central bank currency and the cryptocurrency. And as I said, the risk-free asset is in 0 net supply. So if one wants to buy the asset, another agent has to sell it. Okay, yes?
What is the difference of your equilibrium model of cryptocurrency and another foreign exchange currency?
Another?
Another fiat currency.
Another. Okay, this is here. You will see it's very little. The differences are the following. So, suppose I'm a young investor. Okay, I can consume now, and then I will also consume tomorrow. What I want to do is to maximize my expected utility from consumption. For that, I will decide to buy some cryptocurrencies and some central bank currencies. What's the difference for me to buy one or the other? Well, when I buy, when young, some cryptocurrencies, so suppose that I buy a quantity QT of cryptocurrency, and suppose that my cryptocurrency has a price PT, so a number of apples. So if I want to buy 1 unit, I have to spend PT apples, okay? When I do that, on top of the price of the cryptocurrency, I will incur some extra cost. And this extra cost in so CYT is the consumption of a young investor. It's the last term, phi t of QT times PT. It's a transaction cost that I pay when I want to buy some cryptocurrencies in order to consume next period. And I don't have this transaction cost if I decide to buy a central bank currency. So that's the first difference, this transaction cost. But of course, when I'm young, I can also buy some central bank currencies, and the quantity that I buy is Q hat T, and the price of this central bank currency is P hat T, and I can also invest in the risk-free asset, and it's ST. Now the second difference, when I am old, what happens? My consumption depends on 1, 2, 3, 4 things. First, I have some endowments, I receive some apples. I might have some goods from my risk-free assets. And then I'm going to consume by selling the cryptocurrencies that I've bought. So how much will I consume? Maybe part of my cryptocurrencies will be hacked. So if I buy QT units, maybe at the next period I will have only a fraction 1 minus H times QT. So that's a second, if you want, specific aspect of cryptocurrencies. So I have only a fraction 1 minus H T plus 1 of my cryptocurrency. And the other assumption is that if I buy goods with cryptocurrency, I enjoy some additional transactional benefit. It is not endogenized in our model, it's taken as granted. It's this theta T plus 1. So if I'm buying goods, if I'm selling Bitcoins, I get some additional apples if you want. And that's the third difference between a cryptocurrency in our model and a central bank currency. Now you could tell me that there are other currencies which could have specific transaction costs. So for instance, Linda has transaction costs for the two currencies, or that could have specific transactional benefits, that's right. But why do we do that? Because then we will collect data to proxy for these transactional benefits and transactional costs. And that's how we'll be able to bring the model to the data. Yes?
I just wonder if the central bank currencies, they are protected by law, but not the cryptocurrencies. So is it any possibilities that the young might instead just create their own new cryptocurrency and wipe out the old one?
So I didn't hear the end of your question, but regarding the first part, there are some aspects of central bank currencies that exist in practice that we do not model. The only thing that we assume, because it will help us derive our equilibrium, our return equation, is that the price of the central bank currency doesn't go to zero. You can think of it as being the result of an intervention of the central bank. But that's the only aspect, and it's only because we divide everything by the price of the central bank currency. So we don't want it to be to zero. But that's the only thing that will, so the only differences between our two currencies are transactional costs and benefits for, and the risk of hack for cryptocurrencies, and the fact that our central bank currency has a price that doesn't go to zero. Yes, Linda. Exactly, or the risk-free rate directly pins out the inflation rate. Yes, you're absolutely right. That's what's going to happen. Okay, so you see, super standard, except that we have this cost, phi, risk of hack, H, and theta, transactional benefit. And again, how will we, why did we introduce these elements? Well, the transactional benefits, you know, it might be that you prefer to make transactions in cryptocurrencies than in central bank currencies, simply because you prefer that. Or it can be that, you know, you can purchase an enhanced good, so that's, you prefer to use these currencies. Or maybe you will not be expropriated or taxed or anything. But in the model, it's not endogenized. So, but think of these potential benefits as illustrating our theta. And the cost, what is the cost of, so phi prime is the marginal cost of buying crypto? Well, if you have bought crypto, you should know it. It's both the cost of having a wallet, going through exchanges, etc., and also it's going to be the transaction fees that you will pay to the miners. So we'll have these two types of costs, and we'll have proxies for the two. Okay. So what is an equilibrium? Yes?
A completely stupid question, I'm sorry.
No, there's no stupid question.
What's the price of euro? Is it not €1?
Okay. No, it's not stupid. And actually, I think, Linda, you have the opposite. Our numeraire is is the consumption good. So all prices, it's in apples.
Okay, I see.
So all prices are in apples in the model. So the number of apples, the price of Bitcoin is the number of apples that you have to give to get 1 Bitcoin. Well, it was easier for us yes?
Something, it's the second time I see it this afternoon, but like, why there is this assumption that you don't pay taxes if you make your transaction in crypto?
So, we don't make exactly this assumption. We just say this is a potential reason why you could have a transactional benefit. But in a way, we don't explain where this theta comes from. We just state it, and then we're going to estimate it. We're going to estimate whether our proxies for theta matter to explain the variations in the return of Bitcoin. But we don't have like a full model in that sense. It's a potential reason. Okay, so what is a rational expectation equilibrium in our setting? So it's a sequence of prices for our two currencies, cryptocurrency, central bank currency, the interest rate on the risk-free asset, and a sequence of portfolio decisions by our investors, the quantity to buy of each of these currencies, such that first investors maximize their expected utility. Okay, so they choose the quantities given the price of the currencies. They choose the quantities that maximize their expected utility, and such that at each time markets clear. That is, the supply of Bitcoin is equal to the supply of cryptocurrencies, of central bank currencies, and of the risk-free asset is equal to the demand. Okay, so that's our definition of an equilibrium. And in that case, you by simply first order conditions, you derive a very standard formula that gives you that the price, for instance, here it's the price of the cryptocurrency today, is the present value of the expected, if you want, value that you attribute to this cryptocurrency tomorrow. So it's very similar to one section of the paper by Jean Tirole, 85, section 6, I think, except that we have some random shocks and we spell out this hack risk specific to the cryptocurrency age and this theta, this tau that represents the net transactional benefits, so net of costs of using cryptocurrencies. Okay. So this equation, if you never attended a finance course, then it's now. It's very similar to the pricing equation you would get if you were to price the stock of a company. You would have that the price of the stock today is the present value discounted using this. So U prime over this is the pricing kernel. It measures how changes in the price of the stock affect your marginal utility. So it would be more or less the same equation, except that you wouldn't have, in general, to price stock, you think that the system does not collapse and your stocks are not stolen, so you wouldn't have the age. You would have the price of the stock tomorrow, and on top of the price, you would have the dividend tomorrow, which is the cash that the company decides to distribute to its shareholders. So in a way, you would have a dividend D instead of having our transaction term tau times PT. And what we say in finance is that this dividend is the fundamental value of a stock. And by analogy, we say in this type of models that, okay, these transactional benefits, tau times the future price of the cryptocurrency, reflects the fundamental value of a currency. And there's a slight difference between the pricing of stocks and this pricing equation for a currency. Is that this dividend that you receive, it is not multiplied by the price. It's apples directly, if you want, that you receive. And in a way, because you have this dividend in apples, your price cannot go anywhere. It anchors your price. While here, given our modeling, our transactional benefit is multiplied by the price. Which means that, well, there's no anchor, so the price can move a lot if you want. It means also that we can have multiple equilibria, which is a standard feature of this line of models, and probably first mentioned by Kareken and Wallace, and also mentioned in Garat and Wallace. There are many possible equilibria, there are many possible price sequences that satisfy this equation. Just to see one example is that, okay, a zero price is one of many possible equilibria. Okay. Now, if you iterate the same, so this is the relation between the price at day t and the price at day t plus 1, and then you can do the same thing, replacing the price at day t plus 1 by the price at day t plus 2, etc. And you get a pricing equation that relates the price at day t with the price at a date t plus capital K. Okay, it's very standard. Now, just to give you an idea of why you can have multiple equilibria, it may be that at some point, the transactional benefits become very low. And suppose that it becomes below -1. If this happens with probability 1, then the only price at which old investors will be willing to sell their bitcoins is 0. Because otherwise that would destroy part of their apples. So if that happens at some future date, even in a long time from now, with probability 1, then all prices should be equal to 0. But if that happens with probability smaller than 1, strictly smaller than 1, then you can have a price sequence with positive prices up to the point where maybe this happens, that this transactional benefits fall below -1, and then you will have 0 prices afterwards. Okay, let me skip that. So now, to get to the data, we'll have 2 important additional assumptions, and the first one will highlight this, will be important to highlight a property of the dynamics of cryptocurrency prices. We assume now that people are risk neutral. So we get rid of our pricing kernel, and the motivation for that is that empirically, people haven't found a correlation between Bitcoin returns with any variable that correlates with consumption, either consumption, production, or income. So we just get rid of it. So in that case, we have an even simpler pricing equation that relates the price at day t with the price at date t plus 1, again, incorporating the risk of hack and the transactional benefits. Take a sequence of equilibrium prices, and then assume that each price will be hit by a random shock, will be multiplied by a random and independent variable with a mean 1. Okay? Then you get a new sequence of prices that is still an equilibrium sequence of prices. So in a way, you can have these shocks which have nothing to do with the fundamentals of our model, not related to theta, to phi, or to anything, and still they affect the prices. So what we say is that in our model, under risk neutrality, we have rationally, in the rational model, some exogenous volatility. And so, even in this type of rational expectation equilibrium model, we should expect that Bitcoin prices, if you want, move much more than the fundamentals that we identify, which are theta and phi, the cost and the benefit. And I will tell more about that in the empirical part. So now let's move to the econometric model. To get to the econometrics, we make a second assumption. We assume that the price of the central bank currency is can be perfectly forecast from day t to day t plus 1. Why do we do that? Because we want to express the rate of return of Bitcoin, of cryptocurrency, sorry, in terms of the central bank currency. Why? Because empirically what we observe, what we will use, is the price of Bitcoins in dollars. So we want to have an equation that is exactly this. So if we make this assumption, then our pricing equation becomes this one. And it just says that, so ρ is the rate of return on Bitcoin, of cryptocurrencies expressed in central bank currency. And then what does this equation says? It says, well, if I am to hold some Bitcoins, I need to be indifferent between holding a dollar that will give me, and there we are no more in apples, we are in dollars, that will be valued 1 tomorrow, and holding Bitcoin, let's say, given that these Bitcoins will face the risk of hack, H, and will give me a net transactional benefit defined by theta and phi prime, okay? In expectation, all that should give me the same thing as holding my dollar at every date. So conditional on the information that I have at day t. And this is the moment condition that we will use in our econometric analysis. And what you see, oh yes?
Does rho contain psi? The psi that you are psi times pt plus 1?
Psi, tau. Tau, sorry, I should, so tau is no, rho is just the price of Bitcoin divided by the price of dollar minus 1. It's the relative price of the two currencies. Tau, in fact, it will be this theta over phi prime. So tau is in the middle term.
Okay.
That's the okay. Yes.
So I understand this formula. Crypto are perceived in general. If you are trying to make a forecast, maybe you want to see some kind of a graph of force or something like that. Will it make sense in your framework?
So
Basically, to say that there would be several forces over a given period of time, with several equilibria reached by force. To refine your model, would it make sense?
So that's it. That's initially we did not include forks in our data, which is weird because I mean we worked on forks on another paper, and what we did to incorporate these forks, but I'm not sure it's done in the current time series of prices, is to say, okay, if I have some Bitcoins and there is the Bitcoin Cash fork, I receive additional coins, because I received the same amount or I don't know what's the conversion, of Bitcoin Cash coins. And that is added to compute our rate of return. It's as if I add the two prices, if you want. So we incorporate forks when computing the return at every date of our cryptocurrency.
So actually your formula should be seen as the world of crypto, I don't know, a basket of key cryptos.
Yeah.
And not a given cryptocurrency. Would you agree with that?
I would say more that it's one crypto taking into account the benefit that you can obtain if that crypto forks and that you obtain these additional coins, but you only take them into account on the original crypto. So it's just a one-shot extra dividend that you get. So then what happens to the other currency, we don't take that into account. So
Okay. My question is that would it make sense to look for risk neutrality of force, basically to look if force should, let's just say fork currencies should reach several equilibria, or if it does make sense to see it as a wall that would take an equilibria, but maybe actually the given currencies would not reach the equilibria, although the whole amount would.
Okay.
I'm not sure about that.
So I'm not sure. Okay, I will try to answer. And if I don't answer correctly, then we'll discuss it later. Once the other currency exists, after the fork, what we would have then is, for each currency, you could write a moment condition, in fact. So here, I'm not describing the whole equilibrium conditions. There's an equilibrium conditions on the central bank currency, there's an equilibrium condition on the risk-free asset, and if you had another cryptocurrency that's there, you would have another equilibrium relation. And then you should test the two conditions at the same time if you wanted to see if they are consistent with if the prices of the two cryptocurrencies are consistent with one another. That's what you should do in that case. Okay, so one thing you should see from this equation is what is supposed to happen to my required return rho. Suppose that theta increases. Then, for this equation to continue to hold, it has to be the case that the required return decreases. And if at the opposite, the cost, which is phi prime here, if the cost increases, for this equation to continue to hold, it has to be the case that rho increases as well. And this is exactly what we are going to test, whether the required return moves according to the variations of the cost and the benefits of using cryptos. Okay? Okay, the data. So for the moment, we use data between September 2010 and February 2018. It has been extended, but unfortunately, I don't have the results here. But in maybe 2 months, you will have the new version of the paper with the new results. We took the Bitcoin prices from the Kaiko dataset. Okay, for those who know me, the we is Christophe, in fact. And we used 17 major exchanges. So it means processing hundreds of millions of transactions, just looking at transactions between Bitcoin and dollars, just to give you some ideas of the data. Transaction fees are only transaction fees retrieved from the blockchain itself. We computed them in percentage of transaction volume because this is the variable that we have in our pricing equation. It's the transaction cost per Bitcoin exchanged. Okay. And then to proxy for theta and for the other transaction costs, we hand collected as many as we could events. So first we measured to have a proxy for the hacks or losses of Bitcoin. We looked at all of the events which were known in which people lost or were hacked of their Bitcoins. Okay. And then we collected some events to measure whether you can easily exchange Bitcoin against new goods. So that's what we call the like commerce event series. And to build that time series, what we say, okay, each time there is a new category of goods, of services that can be purchased with Bitcoins, it's a +1, but it has to be a new category. So we don't have that many of these events. Or each time you can, for instance, if initially only the US could buy this service, say Expedia, hotel reservations, and if later on it's extended to Europe, then you're going to have a second +1. So that's our COM series. And then we're going to have a second series which reflects how easy, and that will proxy for our transaction costs, how easy it is to buy and sell Bitcoins. And that's what we call the market series. And for this series, what we said, okay, the first time a new exchange opens that allows you, for instance, to buy Bitcoins with your national currency, it's a +1. So the first time you could buy Bitcoin using Polish zloty, +1. First time you could use yen, +1. Now, of course, if at some point platforms are banned, in China, exchange platforms were banned, it's a -1, okay? and we built a series of these events. So this is the data we have. So the blue stuff is the thing we would like to explain. That's the weekly return on Bitcoin during our sample period. And you see it moves a lot. So the average weekly return is about 4.5%, but the standard deviation is almost 18%. So it's very large. So that's our row. Okay, yes?
Returns, what's in compared to the dollar?
Yes, in dollars, price next week, price this week minus price the week before divided by price the week before.
What I was asking for, what are the apples in this type of...
Oh, we removed the apples.
And now you're only considering...
Yeah. This is here. We moved from P, the price in apples, to rho, the return in dollars. That's the, okay. So that's the returns. So then we have a time series of the hack events. So as you see, of course, you recognize the Mt. Gox event. But in fact, even though you have a few, large events, it's not that big. This risk is not super large. It's on average 0.04% of the supply of Bitcoin over our sample. Of course, sometimes you have a big event. So the transaction fees, same thing. So it's a bit tricky to estimate these transaction fees divided by the volume of transactions, because it's not easy to estimate the volume of transactions. We have an heuristic for that that you can have a look at in the paper. We try to be very careful in measuring the exact amount of Bitcoins involved in each transaction. And what you see is that in general, they're pretty low. It's less than 0.01% of the amount of per Bitcoin. And of course, you have a few spikes, like at the end of December 2017, where you had like congestion on the blockchain. But even at this time, it was 0.2%. So, yeah.
Can I ask you
Yeah.
so these exchange hacks are not the same as the hacks that you model, right? Because the hacks that you model would be that you lose money which is stored on the blockchain.
You lose the Bitcoins that you bought. You cannot use them anymore.
Yeah, but you could avoid that risk entirely if you had no money on the exchange wallet, right? So this is, it's a zero, and you still have.
So you could have so think of it. You could have another risk, which would be you would need to transact in peer-to-peer platforms. So you might have the fact that maybe the counterparty is not, does not fulfill its obligation, or maybe you will lose your private key, or but these ones we don't. Of course, if you lose individually your private key, we don't observe that. So we just observe this major events in which people lost their holdings of Bitcoins.
And then I have a question also about the transaction fees. I know these are the blockchain-based fees.
Yes.
Wouldn't it be, if you want to use the data from the hacks on the exchanges, wouldn't it be then more useful to look at transaction fees that you incur when you want to exchange on the exchange?
So we should also include them. You're right. It's just that we try to have them, and it turns out that we can't have them. We can't have them because either the data is not available, and also, there are lots of transactions on exchange platforms which are not actual transactions, and we don't even know whether the fees associated with these transactions are real or not. And we try to, and Christophe said we can't. And
especially for the early part of the sample.
Yeah.
The sample starts in 2011.
Yeah.
Data
2010.
on exchanges at the time.
Yeah. Most of the exchanges that existed at that time do not exist anymore. So we don't have the data on that. So we wanted to have that, but we could not. Yes?
Why don't you take into account the Bitcoins which are lost forever, like sent to the Satoshi address?
You mean in the model or in the
Because it could
So in the model, as long as people are aware of that,
put into your hacking parameter, but saying that for the econometric, more looking at how much bitcoins have been lost forever than how many.
so it doesn't change our equilibrium equation, because this equilibrium equation does not depend on the supply of bitcoins, except in the model through the marginal cost, which could depend on the supply, but in our specification, we don't make it depend on the supply. So it's not going to change our econometric model.
The whole will not be changed.
No.
by that.
No, because the price changes with the supply, of course, but not the rate of return that you ask compared to the dollar. Because you adjust the price to this supply. So this is the time series of our commerce and common market events. So you see the yellow line. So this is how easy to buy new goods and services with bitcoins. So of course initially it's very low. You couldn't buy anything. And then as new companies start accepting bitcoins, then you have this events, this index that moves up. And sometimes it's so when Expedia accepts Bitcoin, it's a +1. And when Dell no longer accepts Bitcoins, it's -1, etc. But overall, it's increases over time with some changes. And the blue line is the market event. So of course, it increases mostly initially when new exchange platforms open, offering the possibility to citizens of different countries to use their national currency to buy bitcoins. Then it goes down because that's Mt. Gox. That's a big negative event, a series of events. And then it goes up if there are some more, if the futures market opens, it goes up again, etc.
Is there any reason why when China bans bitcoins, the market will
So,
fall?
when China bans bitcoins, it is equivalent to an increase in the transaction cost. The model predicts that in that case, the required return should increase. Now, whether it's the price today that decreases compared to the price tomorrow, or the price tomorrow that increases compared to the price today, we don't solve explicitly for prices. We just have this return relation. But what the model predicts is that the required return should increase in that case. Okay, so how much time do I have, Chairman? So you're super lucky because I have a flight tonight to go back to Toulouse. So, okay. So what we do is that we use GMM to estimate our model and to see if the proxies that I've just described for the transactional costs and benefits matter to explain the dynamics of the returns. And to do that, we say, okay, our theta, we're going to proxy it as being a constant term, alpha 0, plus a coefficient, alpha 1, times our index on this commerce series. That's theta for us. And the transaction cost, the marginal transaction cost, phi prime, it's going to be proxied by two types of variables. One is the transaction fees per Bitcoin, and the coefficient for that variable will be beta 1. And the second one will be the inverse of our market time series, beta 2. So what we want to see if do alpha 1, beta 1, and beta 2 matter when we take the model to the data. So we write our moment condition as saying that, okay, in expectation, the required return should be equal to 1, so the residual, conditional on the information I have at day t, should be 0. And we use as instruments all the model variables that are evaluated at day t, plus any variables that we could find that could correlate a bit with the return next period. Okay. Now, just to be very, very quick on that. So we have one good news, which is that this coefficient I've just described, they have the correct sign. And at least the COM and the market series have significant coefficients. So, which means that when transaction benefits increase, the required return decreases. And when transaction costs, and when it becomes harder to buy Bitcoin, say China bans Bitcoins, then the required return increases. Okay? Transaction fees, they have the correct sign. They are significant, but you see, not as the coefficient is not as significant as the other two. So maybe what is more meaningful, I think, to understand the exercise is to say, okay, what is the required return that our estimates on Bitcoin, that our estimates imply? So to do that, we just do a first order approximation of our expected return, and we say more or less, the expected return on Bitcoin should be the sum of, so it should be the transaction cost plus the risk of hack minus the transaction benefit. Oh, it's very. And what we do is that we use our estimates to compute what is the required return implied by our model given our data. And we get this. So the top blue line is our computed return, which is the sum of transaction costs plus hacks minus transaction benefits. That's the blue thing. And you see that initially what happened is that, okay, you couldn't do much with Bitcoins. The commerce index was very low, so there was not much use of Bitcoins. And at the same time, it was quite costly to buy Bitcoins. So the market component was very high. And so in that case, the cost of buying Bitcoins accounted for more than 15% of required returns. And as time goes by, what you see is that if you can buy more and more goods, so the green line decreases, it means that you're more and more happy to use, you can do more stuff, buy more goods with your Bitcoins, and then it decreases the required return. And at most, it decreases by more than 6%. And at the same time, it becomes easier and easier to buy Bitcoins, and so the required return decreases as well with that. And that's why our blue line decreases. Now there is you see a jump at the end of 2017, 2017, which corresponds to the period in which there was congestion on the network. And in that case, it's the transaction fees that drive the required return up. Now, the last thing we want to point out, going back to exogenous volatility, is, okay, so we have our, we can compute what the estimates from our model imply the required return should be. And we can compute the standard deviation of our estimated return. It's 3.43%. Now, I told you that the standard deviation observed was 17.9%. So overall, these fundamentals that we identified, they are significant, but they explain less than 4% of the variation of Bitcoin returns. Does it mean that the model, is it inconsistent with our model? No, because what I told you is that in our model, there can be some exogenous volatility. So of course it can be that there are some other important variables that drive this return that we haven't incorporated in our model. So think of it, the part that we don't explain as being the upper bound on the exogenous volatility implied by our model. So just to, in a second, if you're interested in that question, okay, coming soon. We extended the sample until last December. We included more countries to account for countries for which citizens might have some demand for Bitcoin, countries which use a lot of, which have a lot of remittance services, so countries which have citizens who work abroad and send money back home. So we enlarged the set of countries to consider in our market series. So far, we didn't put some weights on all these events, but probably some are more important than others. So when China decides to buy an exchange platform, it should be a major event compared to others. So what we did recently is to weight all these events by their importance. And what we did also is to add some variables to in the proxy for the transactional benefits. And so we added volatility, congestion, number of active addresses, apparently addresses that don't do anything in our model. Congestion for the moment doesn't do anything, but volatility seems to be important. And that's it. Okay, to wrap up, we try to provide a theory to understand what can be the fundamental value of Bitcoin attributed by its users. And what we try to highlight is that because these transactional benefits are multiplied by, or proportional to the price of the cryptocurrency, that gives rise to a multiplicative structure and to some exogenous volatility, which is inherent to this cryptocurrency. And empirically, we found that our fundamentals, they do explain some part of the time variation in return, although a lot of it still reflects exogenous noise. Okay, thank you.
Sorry, just can I ask a clarifying question?
Oh, yes.
So if I understand correctly, you use GMM to back up the coefficient on your two proxy variable, the com and the market, and then you use those coefficients in the exercise where you try to see the predicted evolution of the yes, this one. But is this correct? Like, if your goal is to find the coefficient, so say that your goal is exactly to figure out how to better match the existing return with your variables, or for example, how to match better the variance. So in some sense, wouldn't you want to estimate a model that has exactly the metric that you're trying to match should be part of your GMM estimation? It's a
Sorry,
question.
your last
So
point?
basically, you're building this estimation, try to basically get as close as possible to minimize to.
Yeah.
Okay.
The
But then you
distance
use this to
between
do
the,
something else, which is to measure how well you predicted return match the existing return. Is it the same as what you're doing, or would
So
it be
one thing is to use GMM to see if our coefficients are significant. And once we have our estimates, you can visualize. It's a way to visualize our estimates. So if you want, it's another way to present this is another way to present our estimates. It's not a different exercise.
Is it not? So it wouldn't be minimizing the distance between the predicted and the actual? Give you
So that
different
gives us our
coefficients?
estimates. And then you can recompute them to show them here with this decomposition. But it's not a different exercise. Yeah, that's the predicted using the estimates from the GMM.
Hi, thank you for this presentation. Could you come back to a description of the commerce series, please? And as far as I understood, it only include B2C commerce. And so far, maybe I'm wrong, did it include peer-to-peer commerce or C2C commerce as well?
For instance, what do you have in mind? No, it's Bitcoin.
I mean, like, consumer to business. I mean, like, when I see Expedia announcing Bitcoin or whatever kind of big corporation announcing Bitcoin payments, that is one output of payment with cryptocurrency. But what about the peer-to-peer
What do you mean?
But it is commerce when you go, I don't know, to any kind of digital services where...
Oh yeah, there are digital services that are also included.
So it's not only blue corporations?
No.
Okay.
It's all, I mean, it's all services and goods that we could find. It's hand collected, so we try to, have a. So then you have to browse all the websites. What can you do with bitcoins, and we try to group them in categories. And each time a new category of goods and services can be purchased, it's a +1.
Including peer-to-peer communities selling each other services and goods, including the darknet and everything like this.
Yes, and including the darknet.
Okay.
So yes, I forgot to say it. Sorry.
Was a huge volume
we consider both legal and illegal stuff that you can buy with Bitcoin, so long as we get the information. So when Silk Road closes, it's a -1. If that answers a bit your question. Yeah. We merged illegal and illegal goods. Again, given the information we could find. And you have at the end of the paper, by the way, you have the whole list of the events that we took into account. And if you saw some events or some categories that say, oh, you didn't think about it, please send us a message and we can complement our series. It's just by lack of knowledge and not by, it was not strategic.
So, may I? Okay, I have a naive question about the interpretation of the result. So, if you look at the bubble, so...
If you look at?
Look at the bubble at the end of 2017. Yeah. So, let me know if I read it correctly. So, what you said is that the transaction fee went up, and this raised the required rate of return, which I think is the logic of the model, but I think it's pretty much the other way around, is that there was this bubble, and this created congestion. No, I understand, and this created congestion because people were selling and buying like crazy, trying to make return quickly, and the fees went up, no? Or is it unfair to say that?
In the model, you incur your transaction fees at day T, and that gives you some required return for day T +1. And this is what we use to compute here.
Yeah. No, I understand that. In my explanation, I take the transaction fee as exogenous, so that's not like not the rate of return as exogenous, which you want to explain. But I think in reality, that's pretty much what happened. No, I mean that people were speculating like crazy. The network was congested, and they started to pay transaction fee because they were hoping a return. No. Is that fair?
Yes. I mean, what you would like to have is something that endogenizes our transaction fees. Because our transaction fees, they're just, okay, people react to the transaction fees today, and they require some return in compensation for that tomorrow in order to continue to buy Bitcoins. That's what the model says. But the model does not say, why do we have high transaction fees? I guess this is your point.
I also think that basically our model is not a good model to explain the model.
No.
It's related to what Catherine said. She said we only explain 4% of the volatility, and so we definitely don't explain why there was an increase in prices at this time.
But then at this time there was this feedback loop in the transaction fee, and then it's getting a bit out of there.
So would it be useful to compare it to penny stocks or junk bonds?
I think a big difference. And when you think about these cryptocurrencies, and as you said before, they are very much like currencies, we have to bear in mind they're different than stocks, or they're different than bonds, because stocks and bonds, they pay you something that is not directly influenced
by the
stock price or the bond price. They have this anchor. And so that's why volatility in currencies or cryptocurrencies is a different animal.
It's subjective, I think.
Yeah.
So I have a question as a computer scientist, so I'm very ignorant on models in finance and economics. So the original question was, is the price of Bitcoin rational? Has it been historically rational or not.
So it's
right?
more the return, return that we observe here.
So I guess I haven't quite
than
understood
the level of price.
the results. So basically, your model takes the historical data that you can collect, you draw a curve, but where is the prediction? So what is the, what is the value of this model if we cannot make predictions?
No, you're right. I should have started with this.
Right.
I will not be able to predict anything on the future price of Bitcoin. And these models, they can't predict the future price. All I can say is that, okay, there is some evidence that the required return moves in relation to some extent, to these transactional benefits and costs. But these are not models that predict the price tomorrow.
Because in some other talks we heard about the network effects and these type of things, but here...
So here we don't have...
Your model of Bitcoin.
You're right. We don't have a network effect in the model. It might be that in reality it affects prices. We try to do some tests in the empirical analysis to see if the number of active addresses has an impact. And I think that we didn't find any. But maybe because our econometric model cannot take that into account properly, that's possible. Or just one, no? Oh, come on. I mean, the Garat and Wallace paper, it helped us a lot, so I want to have a...
No, I just wanted to try and give a more positive answer to that question, which is I think the beauty of this exercise is that what this literature tells us is that equilibria in these models depend on beliefs which are hard to pin down. And so, but you're not just throwing your hands up in the air. You're saying that there is that component to the price which is very unpredictable, but you're trying to identify the predictable component. So I think it's a very valuable exercise what you're doing.
Thank you.